You use $10,000 for gold, then let's say that silver goes to historical ratio gold silver of about 15. $10,000 divided by 15, that is $666 for silver. That is a minimum, and I think we'll reach a lot higher than that. The ratio could easily go to 10, for example, and you take $10,000 divided by 10, you get $1,000.
The fiat monetary era, where credit will disappear for a while, and all the purchasing power that now is imagined to be in credit actually goes into gold and silver. And the endgame ratio will be somewhere around 15 to 1, could be 20, could be 10.
If gold rises to the projected $10,000 level, a return to historical valuation ratios would trigger an explosive repricing of silver. A return to the classic 15 to 1 ratio would mathematically push silver to $666 per ounce, a level many view as a conservative minimum given the metal's suppression. More aggressive models suggest the ratio could tighten further to 10 to 1, potentially driving the white metal to $1,000 and fundamentally altering the global investment landscape as it corrects decades of underperformance. Egon von Greyerz, founder of Matterhorn Asset Management, and Rafi Farber, creator of the endgame investor, analyze this monetary reset. This shift signifies the terminal phase of the fiat monetary era, characterized by the evaporation of credit and a massive transfer of purchasing power from paper to physical assets. As the imagined wealth in credit markets dissolves, capital is expected to flee into gold and silver, establishing them as the sole remaining stores of value. The endgame scenario anticipates the ratio settling permanently between 15 to 1 and 10 to 1, effectively demonetizing debt-based instruments for a generation. Now, we present the clips from Egon von Greyerz and Rafi Farber's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
There is a massive shortage of both gold and silver, and massive shorts outstanding in the paper markets that can never be settled in physical. Remember, this is really only a paper market and was never meant for delivery. And now the market realizes there are not enough metals for delivery anyway.
This is not the 2011 market. 2011, you can see here, we're at a fair level of shorts. It wasn't anything close to where it is now. This is a totally different situation. Gold is nearing backwardation. So when the red line goes above the blue line, that is gold backwardation between London and New York. It is not forward curve inversion, which I call backwardation primarily, but people use the word backwardation to describe the difference between the London and the New York prices. So I'll just use that word. So you can see here when the red line has been approaching the blue line, these are exact mirror images. Because this is one price minus the London minus the New York price, and this is the New York minus London price, so they'd be mirror images. Once you have the red line above the blue line, then the situation that is now in silver, where bullion banks and merchants cannot hedge, it will mimic itself in the gold market once these lines cross. Now you can see the silver backwardation between London and New York is almost at the level it was in October 9th, when silver first crossed $50. And if the red line is above the blue line, prices have to rise until this situation is alleviated. And you can see as the dollar price of silver rose, that means that silver fell in dollar terms. That's this line over here. I think it's gray or green or whatever it is. So as this line went up, the backwardation that was resolving itself over here reasserted itself with a vengeance, meaning lower silver prices cannot be sustained by the market in these conditions, which is why we are not in 2011 and we are not in 1980, not at all. Silver is going to take a while to stabilize, perhaps a few days, perhaps a few weeks, not much longer than that. And as gold finds its footing, and now it is past $5,000 again, silver will follow, or maybe it will even lead. And as we get into the final financial crisis that leads to the Fed cutting to zero and spitting out dollars into the banking system, people are going to start to panic, not into Bitcoin, not into tech stocks, not into anything else but gold. And the price of everything is going to continue to fall in terms of gold, in terms of silver, most of all, the price of Bitcoin, which will fall to zero in the next financial crisis. 0 ounces of gold. It might be worth a few bucks, but dollars won't be worth anything, so it won't even matter. Why is that? because Bitcoin isn't a thing. It does not exist. It is a code that opens up a safe that leads to nothing.
The precious metals market is currently witnessing a phenomenon not seen since the most acute financial crises: severe backwardation between London and New York. Unlike the 2011 peak, today's market is defined by a massive shortage of physical metal, making outstanding paper shorts impossible to settle. As the red line of spot prices crosses above futures, it signals that bullion banks can no longer hedge their exposure, creating a trap in which lower prices trigger backwardation with a vengeance, making them unsustainable. As the Federal Reserve is forced to cut rates to zero to combat the coming financial crisis, the analysis predicts a panic that will bypass modern assets completely. While tech stocks and Bitcoin are dismissed as code that opens a safe to nothing, capital is expected to flood exclusively into gold and silver. In this scenario, digital assets could collapse in real terms towards zero, while precious metals, now finding footing above $5,000, are projected to lead the only viable escape from the devaluation of the dollar. Let's get back to the interview.
Bottomed against the Standard & Poor's index and has just turned up and broken now the downtrend and is in a clear uptrend. And that uptrend is a multi-annual uptrend. So we're going to see paper market losing massively against real markets or real commodities like gold and silver. I expect this to last many years, 5 years, 10 years, maybe longer. It's a new monetary era, and that will lead to the end of the present currencies as we know them. And of course, it will also lead to the end of the financial system as we know it. It's not going to totally finish, of course, but it will be totally different in a few years' time, be restructured, because banks will have problems and many banks will fail. Sovereign bond markets will also collapse. Interest rates will go up to percentages that we saw in the 1970s, which is high teens, 20%, maybe even higher, and there'll be high inflation. Let's look at the fundamentals of the actual precious metals. As I pointed out at the beginning, the precious metals correction that we've seen now is a totally normal correction. And obviously, the investors that have bought in the last couple of weeks, they're slightly down now, but gold, for example, is actually unchanged on the year, while silver is a bit down on the year, just marginally. So the move is so fast that we forget the price just a few weeks ago. But remember what I'm saying here, that is that gold and silver are in an era where they will go up by multiples from here. And, obviously, measuring it in paper currency like dollars or euros or yen doesn't give the true picture. That is not the real appreciation of the precious metals. The real one is if you measure it in house prices or in cows or chickens, but nobody does. It's so convenient to use dollars. But investors should really not look at how much money they're making in dollars or how many dollars of metals they have. They should look at instead how much gold they own and how much silver they own and measure that in ounces or kilos or grams if you want. And that's a true measure rather than looking at a paper price, which is actually meaningless when the currency is being debased by the day. Now, we should have a look at the exchanges where actually silver and gold are traded. COMEX in New York is a paper market. It's a fake market, or a false market at least, and their prices are being manipulated by big bullion banks and by hedge funds. Let's take, for example, the last drop that we saw on the 30th of December. This is the massive falls in gold and silver, and there are normally circuit breakers that stop the fall and freeze the market for 10 minutes for the market to recover. But the hedge funds have found a manipulative way of really cutting out these circuit breakers so they can set prices and price limits that circumvent the circuit breakers. And that's what they did on Friday. So we never saw a 10-minute stop in the metals markets on Friday. Instead, we saw a 5-second stop that is hardly noticed. And this is the way that hedge funds can actually circumvent the circuit breakers and continue trading throughout the day and continue selling, which really is totally against the spirit of how the circuit breakers should work. But of course, hedge funds are more clever than whoever sets up the system.
Gold open interest near 20-year low. And this is the main reason, let me just move my face over here. This is the main reason why I say this is not the market of 2011. It's not the market of 1980 rather. This is a very minimally speculative market. There's something going on a more fundamental level in gold and silver right now, and this is the proof of that. We are now at 400,000 contracts open in gold futures open interest for the first time since bear market bottom 2015. Or you could say here, we were briefly below it in 2016, fine. But basically, this area of open interest is at a bear market bottom level. So that's pretty extreme. The only other times where we touched that level since bear market bottom was in the beginning of 2016, the very, very beginning of the bull market that we are currently now still in, and in the beginning of 2017 over here, and at the end of 2018, beginning of 2019, when this real move started to get underway and we broke the 6-year trend, the 6-year trading range that we broke in 2019. So you can see here that these were all major lows in the gold price. Price has not gotten anywhere close to that since. And if open interest is at 400,000 now, you can bet that we are somewhere around a bottom, if not in time, then in price. Meaning it could take a few more weeks for the price to stabilize and begin its uptrend again. But open interest is not going to get much lower than this. So we're at a low here, or around a low, if not in time, then in price in gold. 140,000 contracts erased in 10 days. 10 trading. I don't think this has ever happened, except maybe once in the 1970s. Could be, but not in the modern era. This has never happened before. You can see here that the high in open interest was about $542,000. No, sorry, 542,000 contracts, excuse me. Over here in late January, and 10 trading days later, we are at 400,952 contracts. This is unprecedented. This is pretty extreme. That means all the speculators are out, or almost all the speculators are out of gold futures, and there is plenty of room for a massive run going forward with increased open interest. All the averages are intact, and the weekly close is steady. This is gold prices on a weekly candle chart. And you can see here that on a weekly closing basis, despite the surge and the crash that is freaking all the gold bugs out and destabilizing emotions here, you can see on a weekly closing basis, we're pretty even. We haven't moved much at all. The weekly closing is about $5,000. That's where we are today. So it's more accurately, we're coiling here on a weekly candle basis. The gold price is stabilizing. It is not crashing on a weekly basis. And we're going to head higher pretty soon as the dollar continues to deteriorate.
The gold market is currently flashing a historic technical signal as open interest collapses to near 20-year lows, dropping to roughly 400,000 contracts. This massive erasure of 140,000 contracts in just 10 trading days indicates a complete washout of speculative froth, resetting the market to levels last seen at the 2015 bear market bottom. Despite hedge fund algorithms circumventing circuit breakers to induce panic selling, the weekly closing price remains stable around $5,000. This divergence suggests the asset is coiling for a major move upwards rather than crashing, having successfully purged weak hands. We are witnessing the early stages of a monetary restructuring that will likely see interest rates return to double digits as sovereign bond markets falter. In this new era, true wealth preservation depends on ignoring misleading dollar valuations and focusing on physical accumulation as the legacy financial system faces a fundamental and inevitable reset. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.